Welcome to our deep dive on credit score optimization. I'm not just going to give you the standard advice you've heard 1,000 times. Today, we're going beyond the basics to explore what truly moves the needle when it comes to your credit score. Whether you're trying to qualify for a mortgage, secure better insurance rates, or simply improve your financial standing, understanding the factors that genuinely impact your credit score can save you thousands of dollars over your lifetime. Did you know that according to recent data, the average US FICO score stands at 717? But there's a massive gap between those with excellent credit and those struggling to improve. For context, the difference between a fair credit score and an excellent one could mean paying an extra $150,000 in interest over the life of a mortgage. In this video, I'll break down the factors that have the biggest impact on your score, lesser-known techniques that can provide quick improvements, recent changes to credit scoring models you need to know about, and strategies tailored for different credit situations. Let's get started with the fundamentals before diving into the techniques that truly move the needle. Before we talk about optimization strategies, it's crucial to understand what actually makes up your credit score. The FICO score, which is used by 90% of top lenders, is calculated based on 5 key factors. Payment history, which accounts for 35%. This is the single most important factor in your credit score. Lenders want to know if you've paid past credit accounts on time. Amounts owed, which makes up 30%. This looks at how much debt you're carrying, with a strong emphasis on your credit utilization rate, the percentage of available credit you're currently using. Length of credit history, which is 15%. This considers how long your credit accounts have been established, including the age of your oldest account, newest account, and the average age of all accounts. Credit mix, which accounts for 10%. This evaluates the variety of credit accounts you have, such as credit cards, retail accounts, installment loans, and mortgage loans. New credit, which is also 10%. This looks at recently opened accounts and recent inquiries. It's worth noting that while FICO is the most commonly used scoring model, VantageScore is becoming increasingly important. The VantageScore model weighs factors slightly differently, but follows similar principles. A major change is coming in late 2025 when mortgage lenders will be required to use both FICO Score 10T and VantageScore 4.0 instead of the older classic FICO model. These newer models incorporate trended data, looking at 24 months of credit history rather than just a snapshot. This gives lenders a more comprehensive view of your credit behavior over time. Now that we understand what makes up a credit score, let's focus on the strategies that will have the biggest impact. Let's start with the strategies that will give you the biggest bang for your buck. Payment history, the foundation. Since payment history accounts for 35% of your FICO score, consistently making on-time payments is non-negotiable. A single 30-day late payment can drop a good credit score by 80 points or more, and it stays on your report for 7 years. Action steps. Set up automatic payments for at least the minimum due on all accounts. Use calendar reminders and account alerts. If you've missed a payment, get current as soon as possible. Credit utilization, the quick win. Your credit utilization ratio, how much of your available credit you're using, is the second most important factor and one you can often change quickly. Most experts recommend keeping your overall utilization below 30%, but here's something most people don't know. Those with the highest FICO scores, 785 and above, typically maintain a utilization rate of just 7% or less. Insider tip credit card issuers typically report your balance to credit bureaus once a month, usually on your statement closing date, not your due date. This means you could be using a high percentage of your credit during the month, pay it off by the due date, and still have high utilization reported. Action steps. Aim to keep individual card and overall utilization below 10% if possible. Make multiple payments throughout the month to keep balances low. Ask for credit limit increases, but don't use the extra credit. Pay down balances before they're reported to bureaus, typically your statement closing date. Here's a strategy that can boost your score by 20 points or more in 30 days. Pay down your credit card balances to below 10% utilization before your statement closing date. This ensures a low utilization is reported to the credit bureaus. Now, let's explore some lesser-known techniques that can significantly impact your score. Authorized user strategy. Being added as an authorized user on someone else's well-established credit card can be a powerful way to improve your credit, especially if you're starting out or rebuilding. When you're added as an authorized user, the entire account history often appears on your credit report. If the account has years of on-time payments and low utilization, this can dramatically improve your credit mix, length of history, and payment history all at once. Insider tip: you don't need to actually use the card or even have the card in your possession to benefit from this strategy. Action steps. Ask a trusted family member or close friend with excellent credit history to add you as an authorized user. Make sure the account has been open for several years, has on-time payment history, and low utilization. Verify that the credit card issuer reports authorized users to all 3 credit bureaus, not all do. Reporting non-traditional payments. Until recently, regular on-time payments for rent, utilities, and subscriptions didn't help your credit score. That's changing with services that allow you to get credit for these payments. Experian Boost is a free service that lets you add utility, phone, and streaming service payments to your Experian credit report. It's now also possible to add rent payments if they're made online to certain property management companies. According to Experian, users who see an increase from using Boost average a 13-point gain in their FICO 8 score. Action steps. Sign up for Experian Boost to report eligible utility, phone, streaming, and rent payments. Consider third-party rent reporting services like Rental Karma, Rent Track, or Credit Rent Boost if your rent payments aren't eligible for Experian Boost. Look into credit building features with banking apps and services. Strategic credit applications. When you apply for credit, the resulting hard inquiry can temporarily lower your score by a few points. However, credit scoring models are designed to encourage rate shopping for certain types of loans. Insider tip: for mortgages, auto loans, and student loans, multiple inquiries within a 14 to 45-day period, depending on the scoring model, count as just one inquiry. This shopping period is not applicable to credit cards, so space those applications apart. Action steps. Concentrate your rate shopping for a specific loan within a 14-day window. Space out credit card applications by at least 3 to 6 months. Apply for new credit only when needed. Your approach to credit optimization should vary depending on your current credit situation. Let's look at strategies for 3 common scenarios. Building credit from scratch. If you have little to no credit history, you need to establish credit files with the bureaus before you can start optimizing. Action steps. Start with a secured credit card that reports to all 3 bureaus. Consider a credit builder loan from a credit union. Use the authorized user strategy mentioned earlier. Look into new-to-credit products like Petal or Deserve. Use Experian. Go to establish a credit file, then utilize Experian Boost. With consistent application of these strategies, most people can build a solid credit score within 6 to 12 months. Rebuilding after credit damage. If you're rebuilding after financial difficulties, your approach needs to balance addressing negative items while building positive history. Action steps. Get caught up on all past due accounts. Consider negotiating pay for delete with collection agencies, though this is becoming less common and effective. Dispute any inaccuracies on your credit reports. Use secured cards and credit builder loans to establish positive payment history. Consider becoming an authorized user on a trusted person's account. Remember, negative information generally stays on your credit reports for 7 years, but its impact diminishes over time, especially as you build positive history. Fine-tuning. Good credit. If you already have good credit, say 670 or higher, but want to reach excellent status, which is 760 or more, your focus should be on optimization rather than foundational building. Action steps. Maintain perfect payment history. Keep utilization under 7% on all cards. Don't close old accounts, as the average age of accounts matters. Strategically add credit when beneficial, like reward cards or 0% offers. Monitor your credit reports regularly for errors. Be strategic about when you apply for new credit. Moving from good to excellent credit can save you tens of thousands of dollars over your lifetime on mortgages, auto loans, and other financing. Credit scoring models are constantly evolving, and staying informed about these changes can give you an edge in optimizing your score. In a major update, The Federal Housing Finance Agency announced that mortgage lenders will be required to use both FICO 10T and VantageScore 4.0 starting in late 2025, replacing the older classic FICO model. Key changes to know first: trended data analysis. These newer models look at up to 24 months of account behavior, not just current balances. This means consistently decreasing your balances over time is viewed more favorably than carrying the same balance or increasing it. Second, medical collections treatment. In newer models, paid medical collections have less negative impact. In FICO 9 and VantageScore 4.0, paid collections of any type have reduced impact compared to older models. Third, rental history inclusion. VantageScore 4.0 can consider rental history when it's reported, which may benefit those with limited credit history. Fourth, alternative data. VantageScore 4.0 takes into account alternative data like utility payments, which can help consumers with limited traditional credit experience generate a credit score. Another important change is the shift from tri-merge to bi-merge credit reports for mortgage lending. This means mortgage lenders can pull credit reports from 2 credit bureaus instead of all 3, which may lead to more competition and potentially better deals for consumers. There's a lot of misinformation about credit scores. Let's clear up some common myths. Myth 1. Checking your own credit hurts your score. Reality. Checking your own credit creates a soft inquiry that doesn't affect your score at all. Myth 2. You need to carry a balance on credit cards to build credit. Reality. Paying your balance in full each month is ideal. You don't need to pay interest to build credit. Myth 3. Closing old or unused credit cards helps your score. Reality. Closing old accounts can actually hurt your score by reducing your available credit, increasing utilization, and potentially lowering your average account age. Myth 4. You have only one credit score. Reality. You have dozens of different credit scores based on different models and data from different bureaus. Focus on the factors that improve all scores rather than a specific number. Myth 5. You and your spouse share a credit score. Reality. Credit scores are individual even if you have joint accounts. Each person has their own credit history and score. Myth 6. Income affects your credit score. Reality. Your income is not a factor in credit scoring models. A person with modest income can have an excellent credit score with good credit habits. Now, let's put everything together into a practical game plan for optimizing your credit score. Step 1. Know your starting point. Get your credit reports from all 3 bureaus at annualcreditreport.com. Check for errors and dispute any inaccuracies. Note your current utilization ratios, account ages, and any negative items. Step 2. Address the biggest factors first. Ensure all payments are on time. Set up auto-pay. Pay down high-interest debt and reduce utilization. Don't close old accounts. Limit new credit applications. Step 3. Implement advanced strategies. Time your credit card payments before statement closing dates. Look into becoming an authorized user if appropriate. Sign up for Experian Boost or other alternative data reporting services. Consider a mix of credit types if you only have one type. Step 4. Monitor and adjust. Track your credit score monthly. Many credit cards and banks offer free access. Adjust your strategy based on what's working. Be patient. Significant improvements take time. Remember, credit optimization is not a one-time fix, but an ongoing process. The most significant improvements typically occur in the first 3 to 6 months, with continued gradual improvements as you maintain good habits. We've covered a lot of ground today, from understanding what truly impacts your credit score to implementing specific strategies for your situation. Remember these key takeaways. Payment history and credit utilization have the biggest impact on your score. You can often see quick improvements by optimizing your utilization. Alternative data and becoming an authorized user can significantly boost your score. New credit scoring models are coming that look at trends over time, not just snapshots. Take action today with even one of these strategies, and you'll be on your way to better credit and all the financial benefits that come with it. If you found this helpful, be sure to subscribe for more practical financial advice. Thanks for watching, and here's to your financial success.